Cooler
It
Wednesday.
must be, because we here
Yeah.
again. Hey, everybody.
Hey. Today we got us a good topic. It's really important. So you have some friends that's out there. Please share and like
Or
so
like and
that
share.
we get more people out, to know that we're on. So share. And my
Yeah.
name is Dion Branch, and I am with EXP Realty. And I have my co-host with me today, which is Lisa White. And
Otherwise known as the House Money Mama. And I'm now with Nexa Mortgage, where we bring you everything you need as a broker.
all right. So thank you guys for joining our chat. Good evening, joining our show. So we have a few people. We have a chat open, definitely for some questions. If you have anything you want to know, hit us in the chat, and
Yeah.
that way we can definitely answer your questions as well. But today we wanted to talk about pre-approval, right? The
Yeah.
pre-approval process. So a lot of times, I get people that contact me and they want to buy a house, and so then the first thing I ask them is, hi, what's your name? What you looking for? But
Are you pre-approved?
are you pre-approved? Right. We can't do anything in this process without a pre-approval. So,
That's right.
right. So let's talk about a
Unless you buy
pre-approval.
it with cash, then that's a whole different story.
Yeah.
You
Cash
got a
is
couple $100,000, laying around, then that's different.
right. Cash is king. So cash is, you know. So we definitely could go with the cash first. But if you don't have cash, we need you to be pre-approved. And Lisa probably today will talk about a little about the different financings that you could get a pre-approved for.
Yep.
But let's see, what's the first thing we need to know is a lot of times people ask for a pre-approval, but there's a thing that's called a pre-qualification, and then there's
Hmm.
a pre-approval, and one is better than the other, right?
It
So
is. Yeah. So one is more one is a more detailed one is more detailed than the other. Let's just say it that way. So there are times when people will do something that they call a pre-qualification. A pre-qualification basically just says, okay, hey, I'm having a conversation with you and I'm asking you these different questions about your income, your assets, your history and things like that. And as you answer these questions, I'm writing them down. And based upon what you say, I'm taking that information now, I'm calculating income, and I say, okay, I got enough information that says that I think you should be able to qualify for a mortgage loan. And I can give something like that to you and say that you're pre qualified. Because if that information is accurate, then that would mean that you would qualify for a mortgage more than likely. I don't even know if they do credit pools, like full credit pools for pre qualification. I'm speaking from a position of not really knowing a whole lot about pre-qualifications, to be real honest and transparent with you all, because I don't do them. So to me, what you really should have is a pre-approval as opposed to a pre-qualification, because a pre-approval is the one that's going to be more detailed. So on a pre-approval, I'm definitely doing a credit pool. And in addition to that, I'm obviously calculating the income and putting these numbers together. And I have to know the parameters of different programs so I'll know what type of financing that you would qualify for. Then after I put all those things together, then I can say, yes, okay, this person is going to be pre-approved. And I run something called an automated underwriting system finding. And I use that to make a determination as to the likelihood of an underwriter actually approving your loan.
okay. So
Does that make sense? That's why it's different.
right. So when I'm coming to you for a pre-approval, what are some of the things that you need from me in order to get pre-approved?
That is a very good question. I need your mama's date of birth. I need to know what y'all used to eat for Sunday dinner when you grew up. I need a blood sample. No, I'm just playing. I don't need none of that stuff. But what I do need, I need to be able to verify something that I like to refer to as CIA because it's easy to remember. We all have heard of CIA before, but in this case, CIA stands for credit, income, and assets. So that's what I'm looking for. I need to be able to confirm those items. So first of all, credit, obviously exactly what you think, and most people know that if you're going to get qualified for a home loan, that you need to have decent credit. You have to have a certain, minimum standard that you want to meet for credit. So usually for credit, I do a inquiry, which as a lender, yes, it is a lender pool. Yes, it will have an impact on your credit. Will more than likely take your score down, probably about maybe 10, 12 points, something like that. And then within about usually 30 to 45 days, that should recoup. As long as you don't do anything weird, like go out and buy yachts and, 5 new cars and stuff like that, your credit should pretty much recoup itself after about 30 to 45 days. But the purpose of that inquiry is because as a lender, I have to be able to use the credit report that is calculated by the algorithm that they use for the lending in my field. Because whether people know this or not, a little bit of nugget for you here. When it comes to credit, there are a variety of different algorithms and credit scoring models that are out there that they use. I know of at least about 50 to 60 that they use, and they're different for a consumer. They're different for a lender that's lending for mortgage. It's different for a lender that's lending for an automobile. It's different for a lender that's lending for revolving credit, like your credit card. So all of those algorithms that they use are different. So I can't use your Credit Karma report as a lender. I have to use a credit report that I pull as a lender in order to determine what debts are considered, as being needed to factor into your debt to income ratio on your application for your home loan.
Right. Now, sometimes, people want to kind of see what a couple of different mortgage companies are offering. So,
Mm-hmm.
typically, my
I don't
understanding
know
is
why you would want to do that. Once you come to the house money mama, I gotcha. The house money mama got you. That's all.
right,
Yo, one stop shop, baby. We all right here. But go ahead. What you was gonna say?
right. So, I mean, she's true, right? There's no need for you to go anywhere else, but I'm still gonna let you know because you might go to somebody else and then you need to come to us because we're the ones
Which
that's
has
really gonna
happened
get
a
it done.
lot. Which has
Right.
happened a lot. Yes.
Right. Right. So, but what within that 30 days of you running your them running your credit, then
Yeah.
it doesn't affect you as much. So you're worried about your credit score going down. It's just like shopping for a car. They're looking at it
Exactly.
as you're shopping for a mortgage. So
Right.
if you're getting pre-approval and you want to come to us because you went somewhere else wrong first,
Mm-hmm.
within that
Mm-hmm.
30 days, you can still come to us and get pre-approved without it
Yeah.
affecting your credit score.
Yep. That's
Mm.
absolutely correct. Yeah, because again, they look at it as being one pool because they understand that oftentimes people want to. They actually encourage it, for people to shop. One of the benefits for me, and I wasn't joking when I said this, like it's kind of tongue in cheek, but it's really serious as well. One of the benefits of working with me is that I'm a broker, so I do shopping for you because I'm not tied to only one lender. I have 125 different lenders that I can go to and place a loan at any given point in time. So, with that being the case, the shopping that you probably would normally do, I'm actually doing that for you on the back end. So when
Right.
I look for a product, obviously it's based upon your credit profile and your application, your individual unique situation, and then what it is that you need out of that loan. That's how I decide where to place your loan.
Yeah. And
So
that's
we
the
talked a
difference.
little. I'm
I
sorry.
was
Go
going
ahead.
to
What are you
say
going to
that's
say?
the difference between just a mortgage lender that works at a specific um, mortgage company
Right. Right.
and a
Like a
broker.
mortgage banker. Like a
Right.
Loan Depot is a mortgage banker. Guaranteed Rate is a mortgage banker. Places like that, or just a traditional bank, same thing. They only have their products.
Right.
So with that being the case, there's a little bit less of the ability, for you to have flexibility. If a lot of times, if and not I don't have any wood to knock on, but if I did, I would. If something goes wrong or south, as they say in a loan, I have the ability to recoup that, because what one lender may not do at this given point in time, another lender may. You know
Hmm.
what I mean? So I
Right.
have the ability to say, oh, okay, you don't want to do this, that's fine. I got, 124 other lenders that I can look at who may be willing to do what you're not willing to do.
Right. Okay.
So,
So now
um,
you ran my credit. Now
mhm.
what?
Okay,
Now what
so
else? Now what blood I gotta give you?
right. Another test. So now that I've run your credit, I've done the credit pool, so I have to analyze the credit. That's another thing that's different with a pre-approval versus a pre-qualification. I am looking at the contents of your credit. People think of credit as only being a score. Credit is much more than just a score. When I look at credit, I'm looking at the history of how you have paid. I'm looking at what you have open. I'm looking at, how you have dealt with accounts, because when an underwriter looks at your file, that's what they're going to look at. They're going to try to see, okay, did they just get on as an authorized user 2 months ago on somebody's account? Or, have they been paying bills on time for the past 24 months? Underwriters ask those kind of questions. So instead of waiting for it to get to an underwriter and let them ask it and not have an answer, I ask that question up front. So I look at the credit, the contents of the credit. And actually with credit as well, here's something else. This factors into your debt to income ratio, or what you've probably heard referred to as a DTI. So I have to use that as part of my calculation, because you can only go up to a certain amount. Like on FHA, I can go up to a 56.99% on the back end for that debt to income ratio if the automated underwriting system allows it. If conventional, I can go up to 50% on the back end ratio. So what does that mean? Here's the easiest way I can think of it, because this is how it was explained to me when I was learning about mortgages. It's basically just a math problem. Debt divided by income, and that's your number. So that's the easiest way to think of it. So
Mm.
once I have that credit done, now I know what debt, unless you have like tax liens or child support or something like that, that I need to also factor in, that maybe didn't necessarily come up on your credit, but I still need to include it. Garnishments, if that's not on your credit, but it's coming up on your check. I see it in your paycheck stub. I have to include that in your debt as well. So now that I have that, the second thing, the I in CIA stands for income. So I am looking at your income. I ask you about your income up front, to determine what that is, but I have to do a calculation. So that means that um, the information that you give me, I take that, but then I also have to corroborate it with some documents. So yes, I will be asking you for paycheck stubs. Yes, I'm gonna ask you for W-2s. If you're self-employed, I'm gonna ask you for tax returns. I have to look at all those things, because there's a very specific way in mortgage lending that we have to calculate the income. If you're hourly, I know you say, oh, I make $3,000 a month. I make $15 an hour, and I work this many hours per week. Well, it's not quite that simple for us in mortgage. There's a specific calculation that we have to do. So you may make 3,000, but we may only able to use maybe 2,600 of that 3,000 that you actually make, based upon that calculation that we use for income.
Okay.
So now we've got your credit, CIA, so credit, income, and the A in CIA stands for assets. So assets would basically be, where is your money coming from? Because contrary to what some people think, you do actually need to have money to buy a house.
Right.
so, so there's got to be money, there's got to be money for your appraisal. Some people like to do home inspections, which we definitely recommend. You have to have money for your down payment, and then you also have to have the money for the closing costs, because the down payment and the closing costs are actually two separate things, although they become
Mhm.
the same number at the end to make up your cash to close, because they put everything all together kind of in one bucket. But really, they're two separate items that you have to think of. So
Right.
the assets, I am going to ask you for bank statements. I need to see your bank statements. If you have any kind of assets that's like tied up, say, for example, in a retirement account, like maybe a 401k, for nonprofits, I think they have 403b. You may have an annuity, something like that, anything that can be considered an asset. And just kind of a heads up on that too. It's always good to be able to show assets, because at the end of the day, what the lender really wants to know is, okay, are you going to pay my mortgage every month? Are you going to pay this mortgage? You going to make this payment every month? That's
Right.
all they're concerned about. They don't care about your personal situation. And I'm not saying that we don't as people, because we do. But at the end of the day, the lender, the entity is only concerned about whether or not you're going to make that mortgage payment
Right. They
every month.
want, right. Can you pay? Can you
Can
pay?
you pay? That's what I need
Mm-hmm.
to know. Can you pay? And so keeping that in mind, so your assets actually help to show strength of your loan file. So if you have, rainy day money sitting in the account, you got a few $1,000s sitting in the account. Now that means, heaven forbid something happens. But I mean, I think COVID has taught all of us that anything can happen.
Right.
So we've never experienced something where, a virus basically shut down not only our country, but every other country in the world. So
Mm-hmm.
anything can happen. We know that anything can happen. So keeping that in mind, it's good to have assets, because those assets can show that, hey, if something unexpected were to happen, I have something to draw from.
Right.
So my mortgage does not have to go unpaid, because I have something sitting in the bank where, okay, if I, go on short-term disability because I got injured on my job, I still have something that I can pull from to be able to keep myself afloat and pay my bills, namely my mortgage. So,
Mm-hmm.
so having
Okay.
assets is really important. And obviously, assets are going to be used to pay the closing costs and the down payment when it's time for you to get to the closing table. So you definitely need to have it for that.
Right.
I'm sorry,
And
were you going to
so,
say something?
well, yeah, I got a whole lot.
Okay.
So the one thing about just kind of talking about the closing costs and the down payment, a lot of people, um, when we get to after we pick a house and they're like, "Well, what's my closing costs?" And so then I'll
Uh-huh.
say, I may say, "Well, it's 12,000." They go, "Whoa, the lender didn't tell me it's $12,000, right?" But
Hmm.
what it is like Lisa was saying, it's your down payment, and then because you'll do a FHA, or you could get a conventional with a 3% down. So
Yeah.
then you're thinking, okay, well, I only have $6,000 but to pay. But then there's also fees from your attorney,
Hmm.
from the state, your state taxes. There's a lot of stuff that's included in your closing costs. So it's
Right.
more that could be about 6,000, and then your
And
down
that's
payment
how you
is
get,
about
yeah,
6,000,
that's how you get
right?
up. It's easy
Right.
to get up to 12,000 on a loan transaction.
With
Easy.
the easy, yeah. So and then in a good market, not a seller's market where we in right now. All
Right.
markets are good market, but when it's more favorable for you as a buyer, then I might say, hey, can you pay $6,000 in closing credit, so
Hmm.
they can pay some of your closing fees, but
Right.
they can't pay their down payment, right? They still have to bring some money to the game, right?
Well, something like that. Yeah. So there's going to be specific items that a seller credit can go to. Um, I won't really say that they can't pay into their down payment. There's kind of ways that you
You
can,
can.
but
Okay.
but you have to have what they call a minimum required investment into any transaction. But that minimum required investment can be met by either your own funds, something that you pay out of your money that you generated and saved, whatever, or it can come from a gift, and it can actually come from a part of
Grant.
the tax proration. The tax proration can actually count as part of your minimum required investment. And it could come from a grant, like a down payment assistance program. Any of those things can still count towards your minimum required investment.
Right.
So yeah, you're right. In the buyer's market, when we have the ability to go to the seller and say, hey, do you mind, crediting 3% toward the transaction to help? Yes, that can definitely take your costs down at closing, because that's going to be dollar for dollar. If
Mm,
they credit $3,000 and your closing cash to close amount was $12,000, now that 3,000 from the 12,000 means that you only have to bring 9,000, because it's a dollar for dollar credit.
okay. Okay. So one thing we did talk about a little earlier was your credit. And a lot of times people
Hmm.
have filed for a bankruptcy,
Hmm.
or maybe they've done a foreclosure. So, but
Hmm.
let's say, a bankruptcy. Is
Okay.
it, what's the period of time before I can go ahead and
The
get,
shortest period of time that you would have to wait would probably be from a Chapter 13. You can actually, there are some lenders, and I have some, that will do a loan if you are in an active Chapter 13. And that means that as long you're currently still in it, you're still in the plan, you're still paying, but you do have to have 12 consecutive on-time payments into the Chapter 13 bankruptcy, and you have to obtain permission from the trustee that's assigned to your file. And if you do that, then we actually can still go ahead and get you approved and help you buy a house while you're in an active Chapter 13. Now, the other type of bankruptcy for consumer would be a Chapter 7. The shortest wait time from a Chapter 7 would be 2 years. And it's 2 years from the date of discharge. Sometimes this gets a little bit confusing for people, because they say, oh, I filed my Chapter 7 in September. Well, your trustee didn't actually discharge it until December. So that
mhm,
makes a difference, because we go from the discharge date. So from December of, say, 2020, if you had a Chapter 7, then that would mean that in December of 2022, you'll now be eligible again, to be able to purchase by way of an FHA mortgage. You can use FHA financing for that.
for that? And so then and typically, like if it's December, they should wait like maybe about a month or two just before they start, or can you
Um,
just go ahead
I,
that right away?
I wouldn't. I would get in contact. I would call the house money mama and let her know that you're ready to buy your house and step into your new year in a new house. And we're going to look everything up, on the records from the federal court system and everything. Make sure that the dates are matching up like they're supposed to. But I cannot issue an FHA case number until it has been at least 24 months from the date of discharge of that bankruptcy. But yeah, so usually, again, with the pre-approval, that's another thing we didn't really talk about. How long does it last?
Yes.
Most pre-approvals are going to be good for about 90 days. Definitely FHA. Sometimes with conventional, they're a little bit more stringent. They may only let you do 60, but most pre-approvals are going to be good for about 90 days. So you have time. So if you come to me in December and we look at your credit and we see that it's been, 2 years now, I can go ahead and get everything set up, get your income and everything, get all the things done, all our ducks in a row, so that when you can start looking by the time you put a contract on the house, which probably would be within that 30-day period after I get you pre-approved. When it's time for me to order that FHA case number, you're definitely out of the clear.
Okay. Okay. All right. Any questions out there? Feel free to put a question in the chat if you have a question about pre-approval, getting a pre-approval, and the process that takes place. So let's see. I don't know what else.
Well, I mean,
So
we 24 minutes in, so I think we kind of
right.
we just talked about everything and came all the way through. So credit, income, assets. I think I hit pretty much everything as far as the pre-approval goes. I think I explained the debt to income ratio, that there's a certain number that we have to be underneath in order to make it work. And then the other thing I didn't really talk about, but it's important because with the pre-approval, I do this. It's called AUS, which stands for Automated Underwriting System. So with the automated underwriting system, it's basically a software tool that analyzes my loan file. So it's really only as good, because I've seen people come back with, findings from the automated underwriting system that really were not what they were supposed to be. And it's because they didn't put in the correct information. The findings are only as good as the information that you put into it. That's why it's so important on a pre-approval that you get documentation and enter the actual numbers that you see on the documents. So then
Right.
that way you get the right finding that you need. So for in order to issue a pre-approval, what I'm looking for is something called an approved eligible, which basically means that it thinks that the an underwriter would approve the loan based upon the guidelines for that product that I have you in there being, analyzed for, and that the loan is eligible to be sold on the secondary market. That's pretty much what it means, because that's
Okay.
how mortgage companies make their money, is that we
Right.
sell loans on the secondary market.
So when we're doing this pre-approval, there's a couple of different types of loans that you could get pre-approved for,
Yep.
right? So,
FHA, USDA, conventional, VA. Yep.
okay. All right. And so VA is basically you had some government.
Yeah, it's a government type of loan, but it's specifically for veterans, or it can be for veteran and spouse. You can actually do with the veteran and a non-spouse, but it's really not a whole lot of benefit to it, because then you have to put usually about 12% down. One of the benefits of a VA loan, the hugest benefit, I think, two things really, would be one, that it's a 100% loan, so there's a 0% down. You don't have to put any money into the VA loan. So that's one thing they'll finance. If you find a house for $100,000, they will finance $100,000 for you plus the VA funding fee. The other thing is, on the VA loan, you don't get PMI. I don't know if everybody knows what that is. So just a real quick explanation. PMI stands for private mortgage insurance. And I basically think of it as like an insurance policy for your mortgage. So if you PMI is there because in the event of some kind of a default, if you default, then it allows the lender to be able to recoup some of their investment so that they're not getting a total loss. But you pay for it.
Okay. So you got a VA loan, then conventional loan.
Hmm.
And so conventional is just what?
Conventional would be, usually they want you to have a little bit better credit. Usually conventional is a little less, they're a lot, they can be more stringent with their requirements, as far as credit goes. They're harder on you as far as credit. So they do want you to have like a higher credit score, and they don't want you to have late payments, things like that. There's another type of loan called FHA. Now that is another government loan. And with FHA, they're a lot more lenient. So FHA, you can have medical collections, we can ignore them. You can have up to a certain amount, I think $2,000 in collections that are active on your credit report. We can ignore it. But conventional be like, you got collections, we don't want you. So they're a little different.
Mhm.
And a lot of times conventional also does require a higher down payment. Like, for example, if you're buying a single family home, it's normally 5% down, unless you're a first time buyer. Then you can do a like Home Possible or Home Ready or something like that, and you can put only 3% down. If you have not purchased a home or been on title for a home within the previous 3 years, then you can qualify for something like that. But for FHA, it's 3.5% down, regardless of whether you're a first time buyer or not. Whether you buy a single family, a duplex, a 3 unit, or a 4 unit, it's still only 3.5% down if you use
Right.
FHA.
And then a lot of people, some people have bought a house before, maybe 20
Mhm.
some years ago, and now they're thinking
Yeah.
about, should I buy another house? And oh, I'm not a first time home buyer. I can't get a first time home buyer's benefits. But
Yeah, that's not true. Right. Because technically, if they have not purchased or been on title for a home in the previous 3 years, then they are still considered a first time buyer.
okay. All right. Well. We had a lot of
Well, well,
information.
well.
So you guys, if you need any more information about the pre-approval process or interested in purchasing a home, definitely give us a call. Right?
Yes.
Shoot us a message, and we'll answer your questions for you. We'll also have a personal chat with you concerning your home buying process. Maybe you don't want to share it with everybody. So we are available for private conversations as well. We,
Yep.
it's another water cooler Wednesday. I mean, man. whole lot.
Yeah.
So
Y'all should have got full tonight off the water. Y'all should have got really full.
right. So we do appreciate you guys coming. And if you had any questions, please let us know. Excuse my dogs. I didn't put the gate up in case.
Uh-uh. Hey, Brutus. Where Brutus?
Right,
Brutus always the one getting in the conversation. Where's Brutus?
that's Bella. Brutus is down there chewing on his toy. So
Oh, okay. Hi, Bella.
right, so Bella's in the background right now. Brutus will probably start barking soon. So
Okay.
we're gonna end this call.
Right. Before you come in there.
But we thank you. We appreciate you all joining us on another Water Cooler Wednesday. Next week, we're going to try to talk about, yes, girl. They've joined us today. You see Bruce's head down there. Look, here you go.
So now you
Right. I've been infiltrated today.
so now we know water cooler Wednesdays is not just for people.
Right, right. Bruce said, "What's going on? Let me hear a couple of minutes. What's happening?" So, but
Oh goodness.
yes, thank you for joining us, and we'll see you later before Brutus starts to bark.
Have a good night, y'all.
Good night.